Okay, journal entries, they used to look like this, blah, blah, blah. They look like these, blah, blah, blah. Okay, 25 and 26. I just guys do these for next class. I'm just gonna throw it out before I'm gonna go through them in a second. But does anyone have what the journal entry is for this? What's the debit? What's the credit? For number 25?
Wait, say that again. I'm sorry.
I'm sorry?
I said, can you say that again?
Yeah, for number 25, what did you guys come up with for the journal entry? Just the journal entry.
So supplies, that's an asset, and account. So I'm assuming accounts payable because we purchase supplies on account. That's not our money.
Yep, exactly. So that is the journal entry. Supplies are the debit for 160. I'll fill this in a second. And accounts payable, we owe somebody. And I'm going to go through how we got there, but that is the journal entry. This is August, so 8/29. Okay. So as was mentioned, counts our supplies. Need another P. That is increasing. And accounts payable, we owe more money now. And this is the one that is trickier to write because I did it wrong there, but no, it's an increase. And this one's kind of tricky because I think we usually think of when you owe money as a negative thing, but this is actually saying we owe more money, and I shouldn't have clicked on that. So this is that we owe more money to somebody else, whoever sold us the supplies. Okay. And so supplies be the asset. And accounts payable. Liability. Yep. So it's the accounts payable are, the supplies are increasing with the debit. They're both increasing, but accounts payable is increasing also, but because it's a liability, it's going to increase with a credit. So again, you guys have picked this up. Debits and credits, they really don't mean plus and minus. It just depends on which side you're on, if they're plus or minus. I mean, it depends on what kind of account you have. So there is no one rule as far as debits and credits. And that is confusing. I agree, but you know, it's the way the shorthand is kind of worked out. And there is a beauty to it. And the beauty is that debits will always equal credits. So it makes it more difficult to make a mistake.
Hey, Professor.
Yeah.
Just a random question. Is this how, so you said that they don't do journal entries anymore, that it's not common to see in the workplace anymore?
They do journal entries sometimes. It really depends how the system's set up. But for things that are common, that happen all the time, for instance, sales, every day they have sales, okay? They usually have that in what they call a sales journal. Well, I said, let me back up. Let me talk about this one, specific to this one, so that we just did. They'll probably have a purchasing, what they call a purchasing journal. And they'll have all the purchases from the day in that purchasing journal. So maybe they have 10 of them. What they will do is that purchasing journal will then go to the regular journal, which we'll talk about next week, actually. And it'll make this journal entry. This journal entry gets made. It's just that it gets made from a different journal. So if they have 10 transactions, they would make the same journal entry. It would be made, it would automatically be posted into the journal and put in like this. So, well, it is true that there would be, and it'll look just like a list. It'll say a list of all the people that we just bought stuff from, whoever it is. We bought stuff from vendor A, vendor B, vendor C, whatever. There'll be the list, and they'll put in the dollar amounts and all that kind of stuff. Now that will be put into a journal entry like this from the other journal. So it's sort of like you'd have two journals. Here, I'll show you. Let me do it. That's an excellent question, by the way. Let me change cameras. Is that right? Okay. So here's kind of what would happen. There are different journals that will go into, so you have a sales journal. Oops. If I can write journal. And those of you that are working with a program like QuickBooks or something like that, this will be familiar. You have all these different people you deal with. So you have vendor A, B, and whatever the amounts are that each of those each of those do for the day, whatever that is, 500. 500. What will happen is, you'll just enter it in here. In the background, the sales journal will make a journal entry. Oops. For these items. So it'll look like this. We had the same, we had supplies, I think we had. So these are known as special journals. But all they really are is saying, okay, all of these are going to get the same journal entry. So we'll go through the sales journal when we get a journal of all of them. And then, and these are, this is just a list. But it'll make a journal entry at the end that looks like that. So they do go in on journal entries. It isn't that they don't have journal entries. It's just that if you're doing this as an accountant, that they you'll probably be working more with this for the regular journal entry. Now there's some, not everything is in a special journal. So things that don't happen that often, there's no special journal for. For instance, if you get a mortgage, it isn't like you get 10 mortgages a day, right? I mean, you get a mortgage and buy a building, and it might be years before you get another one, right? So things that are not routine, they don't have special journals for, and those do have to be just regular journal entries. But for the routine things, the things that happen every single day you're going to have sales. Every single day you're going to purchase stuff. Every single day, for those types of things, they do have special journals. It isn't that there isn't a journal entry made. There is. It just comes out of those journals, says, okay, everything in this group all gets the same journal entry. And that's, so if you're working in accounting, for a lot of the routine things, you will just have what they call a special journal. There's ones for purchasing, there's ones for sales, there's ones for, there's one for, accounts payable, accounts receivable, all that kind of stuff, things that are routine, happen every single day. Those things they put in those special journals, and they do it because it's easier. It's and then everything in there actually, it does get a journal entry. It just isn't as obvious because it's everything in that group gets put in usually at once, usually once a day or whatever. But it is possible they could log each one in, but it just depends on the system. But again, it isn't that a journal entry isn't made. It's just that they're made in what they call a special journal first, and then usually if it's computerized, in the background, it'll be automatically put into a journal entry. Sometimes at the end of the day, sometimes it's done immediately. It just depends how it's set up. But yeah, so you're actually for routine things like this is probably pretty routine. You're going to buy stuff every day. You have people you deal with. So this would probably be set up in some kind of a special journal. Doesn't have to be, but a lot of times it will be just because it's just easier and quicker. Okay, and for instance, this next one too, paying for it. Every at least once a month or twice a month or whatever, you're going to pay for whatever you bought. So they bought it on August 29th and they're paying for it on September 9th. So this is, kind of the full cycle. And this kind of why I put it in here, just to kind of show you that it's kind of like a, let me put it in the journal for this. Does anyone have the number 26 journal entry? What'd you come up with? They pay for the supplies purchased.
I did cash and accounts payable.
Good. So cash and accounts payable. So the cash is going down, as is the accounts payable. So these are both decreasing. Okay, so let's see, cash. Okay, so cash is going to decrease with the credit, and accounts payable is going to decrease with the debit. So September 9th. Okay, so that would be the journal entry. And there would be a special journal for this one too. The accounts payable. So you probably have accounts receivable journal, which is usually called billing, or sometimes called billing, I should say, and accounts payable billing, accounts payable journal. And this would be, because this is going to be routine. Every month you're going to pay bills. So, but here's what I want to kind of show you about this. If you kind of look at this, the accounts payable, and this is accounts receivable too. I'm just going to put these down here for a second. you'll notice that these are not really, it's sort of a continuation of same transaction. Because you'll notice if you take these two accounts by themselves, you'll notice that this accounts payable cancels out, right? You put the accounts payable on the book, you pay for it, it cancels out. So really, in the end, the transaction is really supplies and cash. So these accounts payable and accounts receivable are sort of like almost like placeholders, in that it's not completing the transaction just yet. It's like, okay, this transaction really isn't complete yet until we get the payment or we make the payment. So in this case, we bought supplies, and at some point you got to pay for them. So if you look at these journal entries, this accounts payable is kind of just holding in place, saying, okay, when this gets paid off, then then the transaction will be supplies and cash. So whether you buy something on credit or whether you buy it for cash, in the end, it all is going to come out of cash. I mean, it intuitively just has to. So that's why I kind of put these two together, is to kind of show the whole circle of life of a transaction. Question on that thing? So here you're putting the liability on the books because you owe somebody, and then here you're taking it off. If you look at the transaction itself, though, when it's complete, what did you do? Buy supplies, and you ended up paying cash for them in the end, not immediately, but so supplies and cash. Okay, 27 and 28. I'm going to go down to the next page here. So it looks the same. And these are the unearned revenue accounts, and these are kind of tricky in that they're kind of a different way of thinking of things, because this is when someone pays you ahead of time. So this is when someone pays you ahead. I mean, even how it comes about, maybe you give them a discount if they pay ahead of time. It could be if you don't know somebody, you don't know them, they want you to do work for them. You say, okay, well, I don't really know you. I'll do it, but you got to pay me up front because I'm not going to, I don't know you. So anyway, now some of you already did these and did very well with them. Okay, so the advance payment from a customer, what kind of account would that be? What did they pay us with? Oh, come on, you guys are toying with me.
Accounts receivable?
Pay with cash.
Yeah.
Cash.
Yep. So this is cash. So when I see payment or paid, I think cash. Okay, so the first account would be cash. And down here is the tricky one. Now, they gave us cash. We haven't done anything. So this is a liability. And it's kind of similar to an accounts payable with one exception to it. But if we don't do our work, we got to pay them back. So if they give us $220 in advance and we don't do the work, we got to give them the $220 back. So it's a liability, and it's called unearned revenue. And again, this is a liability. It's actually not a revenue at all. Yeah. I don't know what I did there. Oh, I did something. Right here. I lost something completely. Okay. Isn't this fun watching me learn how to use a computer? Okay, so this will be unearned revenue, and hopefully a little more computer savvy than I am, and you didn't delete these. Okay, so cash is increasing. And this is a liability. It's also increasing. So this is kind of a weird thing is that this unearned revenue. This is a liability. It's not really a revenue. Maybe an unfortunate name for it because the name would, imply it's money coming in that we've earned, which it actually isn't. So that's why they stick this unearned.
Excuse me, Professor.
Yeah.
Can you explain a little bit on why it would be considered unearned revenue? I'm a little confused about that.
Because we haven't done anything. This is
What do you mean?
it's an advance payment. For example, they pay us ahead of time. So
Okay.
let's put maybe some more. So let's say the customer paid $220 for me to paint a door. So they want a door painted a special way, whatever they do. I say, okay, I'm going to do it, but you got to pay me up front. You got to pay in advance. I'm not going to do it and then have you not pay me. So they give me a check for $220. All right. Well, I haven't done anything yet. It's not revenue because I haven't earned it. And if I don't do anything, I just got to give it back to them.
So the unearned revenue kind of means like could like you say that you could substitute that word for like work? I know you wouldn't be able to substitute it in the journal, but like in my does that basically mean the same thing as
What?
is like unpaid work? Or
This is kind of a weird thing about this. It actually is paid. It's just paid ahead of time. It's sort of like the opposite of accounts receivable. Accounts receivable is you do the work and they owe you, right? And that's probably the way most transactions happen. You do the work and then you pay, This is a little bit different in that these are for advanced payments or customer deposits. I'll give you one that maybe you've already run into, and that is if you rent a place, sometimes they'll say you have to pay, 2 months or 3 months worth of rent in advance.
oh, okay.
Same thing. Now, you okay, well, I'm paying this in advance. Okay, so, you pay 3 months in advance. Now, whoever you pay that to, they haven't earned it. They haven't earned that rent. They got it from you, but they haven't earned it yet. Not until 3 months goes by or whatever, or you paid for. They can't count that as revenue.
Okay, I think I understand now. Thank you.
Yeah, but it is weird. It's sort of the opposite of accounts receivable. It's when someone pays you ahead of you doing the work, which is not usually the way it happens. Usually you do the work and then you say, okay, I did this work for you and you owe me whatever. But it's sort of the opposite in it. Another one is things like subscriptions, like a magazine subscription or an online subscription. If you pay for a year. You pay for a year of Netflix. Well, Netflix doesn't count that as revenue until, as this year goes on, they'll probably count as revenue. But until the time goes on, they haven't earned it. Not until, the entire year goes by can they recognize that whole thing as revenue because they haven't earned it up until that point.
Okay, thank you.
Yeah. So it's kind of a weird thing. So our cash is going up. It's almost like getting a loan. I mean, in a kind of a strange way, it's almost like getting a loan, except that you're not expected to pay it off in cash. You're expected to pay it off in work. Okay, and so like I say, it's kind of like getting a loan from the bank. So cash is going to increase, and this unearned revenue is a liability. It's an unfortunate term for it. It should be called like customer deposits or something. And but it's sort of like almost getting a loan from a customer. Because if you don't do the work, you got to pay it back. Now, the customer probably wants you to do the work. That's why, so if I need that door painted, I don't want my money back. I want the door painted. So, yeah, but it is kind of a little bit different transaction, and it's the opposite of accounts receivable. Accounts receivable, they haven't paid us yet. We've earned it, they haven't paid us yet. This one, they've paid us, but we haven't earned it. So it's kind of a kooky one. Okay, so September 12th, so 9/12. Okay, so cash. I'm gonna put this in here as an asset. Going up. And unearned revenue for most businesses is probably going to be pretty rare. Depends on the business, but a lot of times, if you're working like construction or something like that, they'll have an initial payment. Oops, right amount in. And if they give a customer deposit, for example, that'd be the same thing. So this would be the journal entry for it. And again, unearned revenue really isn't a revenue at all. It's a liability. It's because we haven't earned it. And actually, let me go down here for a second. You notice under revenues up here. I shouldn't use that. Hold on, it's a bad. We talk about sometimes is he earned revenues or fees earned. This means we've done the work. So revenues, to be revenues, they have to be earned. If they're not earned, you can't count them as revenues. And again, if they are not earned, that's when we come down here and we have unearned revenues. These could also be called customer deposits. Customer deposits is probably a better term, or because again, these are unearned revenue. Immediately, you can't think maybe it's revenue, but they're actually not. Then you owe it to somebody. Let me get rid of this up here. All right. So this would be the journal entry for that. It's a little bit like getting a loan from a customer. Customer gives you money until you do the work you owe them. And again, the only difference is you see, okay, why isn't this unearned revenue payable? The customer probably doesn't want you to pay it back to them. They want you to do the work. So you're actually going to, discharge this liability by actually doing the work. Do the work. Okay, now I've earned it, and we'll see what happens in chapter 3 when you earn it. That unearned revenue will become a regular earned revenue. Okay. This is the same thing. I didn't put a dollar amount in this one. Well, that's going to make it tricky. Okay. That's unusual. This is my third time using this this handout. I created this a few quarters ago, so semesters ago. So kind of surprised I don't have a dollar amount here. Okay. Here's student participation. How much did we receive in advance? You guys get to make it up. So how much did you receive in advance from the customer?
500.
500. Perfect. Okay, sorry about that. Okay, so same kind of thing as the other one. You know, what do we have? We had cash comes in 500. And our new wacky account, unearned revenue. All right, so cash. Revenue. Also, a liability is it's increasing. In fact, I am going to put that as liability, just so that we're perfectly clear that this is not really a revenue. Okay, so I apologize for not sticking it in there. For those of you who did this already and turned it in, don't worry about the, you know, it's missing the dollar amounts. We can still do the debits and credits if you, but you just can't fill it. You can still do which account gets debit and credit. It's just, you know. All right. So again, cash, asset. Cash is going up, and liability is going up. Okay. September 14th. Okay, so cash. The liability. Going up. Any questions on this?
I'm sorry, you gotta say that again.
Cash is going up, and unearned revenue is liability going up. Sort of like getting a loan from a customer. Any questions on this trends on the journal entry for that? And again, I apologize for not having a dollar amount in it. When this class is over, I'm gonna write that down. This class is over. I'm going to put in number 28, and I'll keep the $500. That's a good number. Handout. Okay. All right, well, this handout's done, so I will put this in Blackboard. Do it right now, as a matter of fact. So submit handouts to be created. We'll put this in as assignment. And this is the chapter 2 handout part 2. We'll make it due on October 1st. A week to turn it in, 100 points. Submission details. Limited, highest grade. Submit it there. Okay, so check your handout. We just completed it, so you can turn that in. You got a week to do it. It's not immediate. So that will be due for this. Today, what I want to do next is to do actually a problem from the book. Now I've taken it and altered it a little bit so that it's similar to what we did in the handout. Just to kind of keep it a little bit more familiar when you go from one type to another. So let me, nope, not that. So you should have got a file, chapter 2 textbook exercise 2.7, like that. It's on page 87 in the ebook. So if you get the ebook, it's on page 87. I'm not sure if you have the hard copy, if you have a paper copy. I'm not sure what page it would be on. They don't always match up between the ebook. Okay, and this one again, this is from the book, and if you look in the book, it's very similar. I've changed the numbers on it just because they change them in different editions and all that kind of stuff. So, but the transactions themselves are identical. And I also changed it to 2022, which kind of a funny way of doing it. Okay, now this is something that you'll see from different companies. Companies will have their own list of accounts. And they'll call, these are usually called a chart of accounts. And the chart of accounts are the accounts that they will use. So when you get into accounting, if you go into accounting, they'll have a list of accounts, and those are the accounts that are available. They're usually set up in a system. And the reason being is that you don't want to have people, you can run into getting hundreds of accounts that, someone calls it office equipment. Someone just calls it equipments. Someone calls it equipment for the office. Someone calls it, so to avoid that kind of confusion where you may have the same thing, if, 5 accounts for exactly the same thing, they have a chart of accounts. And these are the accounts that you're going to use. Now, it is possible you have to add some at some point in the future, but they'll have a list of accounts and say, okay, everything fits into these accounts. And if they don't, we'll make an account, but for instance, office equipment. So equipment for the office equipment, whatever. It's going to be, I'll go into this account. So these can be the names. This one isn't too bad. They're all pretty much the same. There's only one that's kind of a little bit wacky. And that's this fees earned. So when we have revenues, we're not going to call them revenues. We're going to call them fees earned just because that's the only account we have. We don't have an actual account called revenues. Some of these other ones, you'll see these are pretty much what you'd come up with anyways: rent expense, advertising expense, utilities, blah, 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 dividends. So this is the only kind of wacky one that we're going to have here. That's a little bit different than what we used before, is fees earned for whatever reason. That's the account they're using. Okay. So let's go ahead and go through here and start filling these in. Probably won't finish these, but I'm gonna give it to you as homework. If we don't, we'll see how much we can get through. We should get through some of it here. Okay, so here's our transaction. Paid rent for the month, $2,100. What are the accounts? Nobody knows the accounts? Who knew? What's one of the accounts? Someone shout out one of the accounts. How about?
Is cap.
Rent expense.
Rent expense. Yes.
Cash?
Yep. Yep and yep. So rent expense. Okay. And you'll notice up here, rent expense is one of our, that's one of our accounts that we're using here. So rent expense, cash obviously. Okay, rent expense. It's an expense. Probably didn't need to tell you guys that. And the good thing about these is they always go up with
So does rent expense go down or up?
it always goes up. Oh,
Does it go up if you're paying down the rent?
well, it's not, if it was a liability, if you had missed a payment on the rent and or you paid after, for the last month, it would have been a liability, it would have been accounts payable or rent payable. But this is paying for the current month. And so it's just counting as money going out for the month. So it's just cash going out. And the expense is actually just counting the money going out. That's really what it's kind of doing here. So expenses are always increasing. As the year goes on, you're going to pay rent for January, for February, for March, whatever, blah, 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 you get the idea. So rent is always going to, until the end of the year, you're going to have a total amount for that rent account. All 12 months will be in that rent account. So expenses are always going to go up unless there's something quite, quirky happens, like there's an error. You overpay the rent and the landlord gives you money back. How often does that happen? But for the most part, they're always going to be going up. So they're always going to be debits. So this is, and it is for the current month. If you pay in advance, which we'll get to talk about in chapter 3, which will be in a couple of weeks from now, it's prepaid rent, but we're not going to worry about that right now. So this is rent expense is going up. They always go up. Oops. And the nice thing about expenses, when you're doing the journal entries, a pretty good rule of thumb, 99.9% of the time, expenses are debits. They don't go down. But like I say, unless something weird happens, like somebody sends you a check back for whatever. But for the most part, they never go down. They just keep increasing. So the good news is whenever you run into an expense, you say yippee. Well, not yippee because you're paying money out, but yippee because you know what the journal entry is. And notice, so let's take, oops, cash is not increasing, it's decreasing. But if you know this one, rent expense is a debit, whatever the other account is, you know what it is. It has to be credit. So coming down, oh wait, let's put these in here. It's cash. October. October 1st, I guess it says. Yeah, you know, these are, yeah, I'm sorry, these are the days of the month. I should have made this different. Okay, so rent expense. Again, whenever you see that expense, this thing debit. They're virtually always going to be debits. So notice though, if you get this, okay, that's an expense. Expenses are always debits. You really don't even need to go through all this, right? I mean, you can, it does work out. But you know, if you get a debit, if you know what the debit is, well, the other account has to be a credit. These have to balance. Expenses are debits. Okay, coming on here. Advertising expense. Is it a debit or credit?
Debit?
So advertising, yeah. Expenses are always debit. So from this, just from reading this, you could automatically put in that this is a.
Was there not a number 2 or 3? It went straight to 4.
I realize what I did wrong here. This should really say, this should really look like this. 10-1. You know, this is for October. So this should be 10-4. Period out. You know, these are supposed to be dates. Yeah, so. So this would be, you know, October 5th, 6th, you get the idea, 12th. You know, but you're absolutely right. It's not obvious. But all right, so for this one, you know, this advertising expense. Now, without even knowing what the other account is, expenses. Debits. Oops. I say everything expense. So whenever you see expense, it's a debit. Now we still need the other account, but you know, immediately when you get the you see there's an expense involved, it's the debit. So whatever the other account is going to be a credit.
Cash.
Yep. So we paid with cash. And again, it isn't that the other account doesn't mean anything, it does. It's just that we already know what it's gonna be. Okay, so coming here. Do advertising expense first. Yeah, so this would be retaining expense, which we've actually already done. So this is increasing. We paid this, or we're paying money out, so cash is gonna go down. All right, so. Cash is the credit, but quite honestly, I mean, if you're just looking at making the journal entry, which probably are, if you know the other one's cash, you could just jump right into the journal entry and say, okay, the other side must be the credit. You know, if we know that these two have to equal. So if we run into an expense, we say yippee. Why? Because checking down here, expenses are always debits. It gets debited. Whatever goes on the other side is going to be the credit. And there's a reason for it, but you know, quite honestly, you're just making, if you just want to make the journal entry, you know, you really don't have to go through this. I would encourage you to, just because it's, well, because I'm an accounting teacher, I tell you to learn that stuff. But for just making the journal entry, if you know one, if you know one's a debit, you know what the other side is. It's got to be a credit. Okay. Now this one we pay cash. Let me fix this. This should really say 10/22. That is not right. Okay, paid cash for supplies. Now, supplies are a little bit tricky in that initially when we buy them, like we did here, it's going to be an asset. We're going to find out in chapter 3 that as we use those supplies, then we expense them. But when you first buy them, they're an asset. So if you, you know, you go out and you purchase a bunch of paper, you know, and until that paper is used up, you don't expense it. Okay. So what two accounts are we going to use?
Cash and supply.
Yep and yep. Okay, cash going up or down?
Down.
Yep.
And supplies is increasing.
Yep. Cash is going down. We paid them with cash. Oops, not that. And supplies is going up. What kind of account is cash? We put that, you guys know that. Supplies will also be an asset. Oops. So these are both assets. So one's going to be a debit, one's going to be a credit. Okay, so which is which?
Cash is a credit, supplies is a debit.
Yep and yep. So supplies is increasing, so supplies will be the debit. So this is an asset going up. This is an asset. Yeah. Okay, down here, let me fix this. I apologize for this. I didn't occur to me that. Now, the book, just so you, just to be clear on what I was why why I screwed this up. The book would have it like this. And so I added other things, that's why I put it into this kind of a document, but that we could have these back. Okay. Number 6. Purchased office equipment on account. What accounts are we going to use?
Equipment and cash.
Yeah, now this one's a little bit tricky, and if just because we already have the they call it chart of accounts. So it is equipment. We're going to use office equipment just because that's what is in the chart of accounts. And if this was a computerized system, that would be the only account available. So we're going to go ahead and use the office equipment. Oops. And accounts payable. Out a little bit. Okay, so we have office equipment. And again, this is going from those charts. So office equipment is going up. And now for the tricky one, what's happening to accounts payable?
Increases.
Yeah, good. Accounts payable is also going up. We owe more people money now. We owe them $10,200 more money. Okay, so okay, so oh wait, okay, so we have office equipment. And I got my camera. We also have accounts payable. And these are both going up. We have more equipment, but we owe more money over here. So office equipment is going up with a debit. And if you just wanted to make the journal entry, you could stop right there. If you know the debit, if you know that Osco is a debit, then you know that the other one must be a credit. But just for fun, we'll come over here. Liabilities, they also increase with the credit. So they're going up, but they're going up with a credit. So we have office equipment. Increasing. Yeah, so journal entries, you know, they are quirky, but truthfully though, like I say, if they only have two accounts, if you can get what one side is, which one's a debit, which one, you know, or a credit, you know what the other side has to be. You know, these have to equal. So if you know one side, you know both. And again, I mean, I would encourage you to go through and you know, see why the liability is a credit, but you know, you really don't need if you're just interested in making the journal entry, you don't need to do that. Okay, this will be our last one we do. Receive cash from customers on account.
Is it cash and accounts receivable?
Yes and yes. Yeah, so this is when they owe us, right? Somebody's paying us. We receive the cash. So we have cash. Okay, so a cash increase or decrease?
Increase?
Accounts receivable?
Increase. Right? No,
What did you say? I'm sorry.
right? Because they're both assets.
They're both assets, exactly. And you're absolutely right. These are both assets. So you think about it, if one goes up and you want the balance sheet to balance still, one has to go down. So yeah. But this is you know, the customers no longer owe us $7,800. They just paid us. Now, don't get me wrong, we're happy to have the cash. But they no longer owe us the $7,800. So this actually would not change your total assets at all, right? One asset went up, one asset went down. Okay, so cash and accounts receivable. Okay, I'm gonna let you in on a little secret. A lot of times we don't write the entire account out. A lot of times you'll see accounts receivable abbreviated like that. So feel free on tests and anything else to abbreviate. There's accounts receivable. AR. You'll even hear people call it AR. You know, the receivable department. What is that? AR. You know, call that. Accounts
We
payable.
we can replace accounts receivable with what AR
Yep.
all the time, or
Oh, well, in my class, yes. I can't see for other instructors, but yeah. And accounts payable, you'll see that often called AP. Those abbreviations are used so commonly that, yeah. Yeah, so if you did, so for this one, so cash is going up. So it'll look like this. That's fine. Yeah, accounts payable and accounts receivable, you'll often see abbreviated. And you'll also often hear people talk about it as, just AR, AP. Oh, this is actually 10/12/2022. Yeah, feel free to use that AR. So that's accounts receivable. But you can also just put AR, either one. Want to type it out completely? You can. And same thing up here, accounts payable. Or yeah, so those are common ones that you have. Okay, let's go ahead and save this. We'll hold off next class. So next class we'll finish this thing up, and then we'll do the practice exam, and then I'll send out the exam, and the exam will be due not this Friday, but the following Friday. Oh, I didn't put up what we're going to cover today in class. I'm running this crappy class anyways. Okay, so this would be what are we doing? Sorry. 2-7. So this one we will turn in. You can turn it in. You have a week to turn it in. Wait, today's Thursday, isn't it? The exam will not. I'll pass out the exam next week. It'll be due the following week. So yeah. Okay, so this one you can turn in. So I put up there. This one I'm not going to put I'll submit on it yet until we kind of go through it. And again, we're going to go a little bit slow on these journal entries, as you have noticed. They are quirky. So anyway, so I'll tell you, my first 2 accounting classes, I got C's in them. I was not, it wasn't like, oh boy, this is so easy. And journal entries were from Mars. I didn't understand them at all. Finally, I did. I think the 3rd accounting class, I finally got an A in. But if this is really weird, it should be. It's the first time you've seen it, and it's a weird 400-year-old shorthand that works very well, and that's why we still use it. But yeah, so hold on to this one, the exercise 2-7. We'll do more of these, and I'll see you guys next week. Any questions? No. All right. This should be up by this evening. This video should be posted. Okay. Well, we'll continue on with this. And by the way, I like doing this stuff out of the book just because it's different than what I do. I'll fix the the numbering on it. But anyway, have a good day, and I will see you guys next Tuesday.
Take care.
Take care.
Thank you.
Thanks.
Have a nice weekend.
I will. Bye.